Hello, America. I'm Camille Chandler, and this is Qualitative Listening. Federal Reserve Chair Jerome Powell delivered a speech today at the second Thomas Labach Research Conference, signaling a shift in the Fed's monetary policy framework. Here's some key highlights from Powell's speech. Number one, reevaluation of monetary policy. Powell announced that the Federal Reserve is undertaking its comprehensive review of its monetary policy strategy since 2020. This reassessment aims to adapt to the evolving economic landscape, particularly in light of recent inflationary trends and labor market dynamics. The current framework, established during a period of low inflation and near zero interest rates, is being reconsidered to ensure it remains effective under current conditions. Number two, increased frequency of supply shocks. Powell highlighted that the U.S. economy may be entering a period characterized by more frequent and persistent supply shocks. These disruptions could lead to more volatile inflation, necessitating a more flexible and responsive monetary policy approach. Number three, reconsideration of inflation and employment strategies. The Fed is re-examining its approach to balancing inflation and employment objective. Powell noted that the strategy of tolerating higher inflation to achieve low employment, adopted in 2020, may no longer be appropriate given recent economic developments. The central bank aims to develop a policy stance that is more resilient to evolving economic conditions. Number four, enhanced communication and transparency. Recognizing the importance of clear communication, Powell emphasized the need for the Fed to better convey the uncertainty surrounding future policy directions. This includes providing more transparent guidance on how the Fed responds to economic shocks and adjusts its policy tools accordingly. So how did the market react? Following Powell's remarks, U.S. stock futures experienced a slight decline, reflecting investor caution amid the anticipated policy shifts. But I wanted to take a second today to talk about the first point, reevaluating monetary policy. We've been doing quantitative tightening since 2022, so let's discuss what quantitative tightening is. QT is when a central bank reduces its balance sheet by selling government bonds and other assets it previously purchased, or letting bonds mature without reinvesting the proceeds. This process strains liquidity from the financial system and tightens monetary conditions. Why do central banks use QT? The goal of QT is typically to cool down inflation by reducing excess money in circulation. Normalize interest rates after periods of very low or near zero rates, undo effects of previous QE programs, which were used to stimulate the economy during crises like 2008 or COVID. One key aspect of monetary policy is interest rates, so we might in fact get a rate cut along with the end of quantitative tightening. And exciting stuff. We will be following closely coming up on June with this next announcements. That's the show, folks. Thanks for listening to Qualitative Listening.